Perfect. So, hello everyone. Thank you so much for joining us today on this masterclass. If you guys don't know me yet, my name is Alexandra, or people call me Sasha, and I'm a Chief of Staff and Marketing Director at BeDriven. And at BeDriven, our mission is really to help emerging brands to grow and scale and navigate the complex world of retail. And one of the way how we do it is during these masterclasses. So this class is a part of the expert series, where we are bringing you multiple experts from different fields in the business and talk about various topics. And so today we have Luke Abbott, who is the founder and CEO of BeDriven. And I will have Luke to introduce yourself, and then we can kick off this presentation as well.
Awesome, thank you. Let me get my deck up here really quick and we'll get presentation mode. Fantastic. For those of you that don't know me yet, as Sasha said, I'm the founder and a coach here at BeDriven. Founded the company about 4 years ago, and I'll talk more about it. I do have a background in accounting and finance and a lot of experience as a CEO. I scaled a company, my team did most of the work. I just had to lead, but from 30 million to 300 million that we ended up selling to KPIs. And so just accounting has meant the world to me. It's a passion that I have. Even though I'm a trained accountant, I am not an accountant today, but understanding the numbers has been so core to my success. And it's something I really want to share with all of you. So I'm going to dig right in. Let me present on this device and we should be able to get started in 1 second here. Perfect. Okay. So the agenda, I'm going to talk about why financials and good accounting matter. I often have discussions with emerging CPG company leaders and they're like, oh, what does it really mean? I can't even understand them. Is it important? I'm going to help you understand why it matters. We'll talk about accrual versus cash accounting. We as a company do accounting for dozens of CPG companies, and almost all of them come to us with either doing pure cash accounting or some blend between accrual and cash. I'm going to help to explain why accrual is so important. I'll talk to you about the purpose of the 30 standard financial statements, and most of you just think about two, which is the balance sheet and income statement. I'll also be talking about the importance of the cash flow statement, especially if you're doing accrual accounting. And I'll give you some tips on reading the 3 standard financial statements. And at the end, I'll talk to you about why cash is so important. And I know this from very personal experience and literally time on the floor praying to God for more money because cash is everything. So let's dig in. So why financials and good accounting matter. So really, if I think about it, as a CEO of a company, I look forward to my financials every month. I look at it as my report card. So Andy Pond is our global financial controller, and 4 days after the end of every month, I have financials. I know how I perform. How am I doing as a CEO? How are we doing as a team in operating our company? When I don't have good financials, and I had that in a previous company, I don't even look forward to them because I don't trust them. So being able to trust these numbers, trust in the report card is absolutely critical, because I'm going to make decisions, almost immediately after seeing those financials every month that have to be based on actual true numbers. So I want to make informed decisions. I also want to make sure I'm reporting my taxes right. I don't know if you guys know this, but if you are committing fraud on your financials, because and part of fraud, by the way, is not being a good steward of doing financials and reporting your taxes. There's no statute of limitations, literally no statute of limitations on fraud for taxes. They can come back to you anytime. So this is something we want to make sure that we're tight on, just if only for that. And also for investors and creditors. I dealt with this, and I've seen so many companies where the financials were not tight. They never built those disciplines into the organization of having accurate financials. And then you start wanting to raise capital or wanting a bank to get involved, and they come and do their due diligence or their audits, and things fall apart really fast. I don't need this stress, and you don't need it either. So being really focused on having tight accounting and accounting internally and your good financial statements you can rely on, absolutely critical. GAAP accounting, you may not have heard the term GAAP. It means generally accepted accounting principles. It matters. GAAP accounting, or US GAAP accounting, is the language of accounting spoken in the United States. It allows me as an investor or even as a CEO to be able to compare my financials to another company's financials, knowing that we all speak the same language or we all follow the same rules. It's the consistent set of rules for how we classify our expenses, when we recognize revenue, and a number of other things. And when you're like working with investors, for example, they're going to expect that your financials are in accordance with GAAP, or you'll need to convert them into GAAP. And the core thing is just to remember, US GAAP accounting is a language. Similar to if someone's speaking French, it's going to be unintelligible to someone that speaks English. Like I can look at it, I can recognize their letters, but I don't really know what they mean. I don't know what the rules are that you use in that language of accounting that you're presenting your data in. So by standardizing on the standard of what we use in the United States, US GAAP accounting, we make our numbers intelligible to other users of those financials. And then it helps also ensure that we're following rules internally in our organization, so I can rely on those financials to make good decisions. Hopefully I made my case. So the other thing I want to make sure you know is you don't need an accounting degree to understand financial statements. I went to school for 4 years to become a degreed accountant. I spent a summer in a 1972 motorhome with flashcards studying for the CPA exam. I passed that, and I got an MBA with a focus in finance and accounting, but that was only so I could know how to prepare the financials. It takes a lot of knowledge. You need someone who's really good at preparing your financials. And part of the deal is to prepare them in a way where the user doesn't need 4 years of studying and need a CPA license, right? I think in this presentation today, if I can give you some more confidence that as a user of these financials that you can understand, you can make a decisions from these financials without needing to understand the details of accounting, that would be a huge win out of this time together. So let's go and dig into this kind of first subject, if you will, accrual versus cash accounting. I get asked about it a lot. And Sasha, do you have a poll handy? I'd like to know who's using cash accrual or blend, or if you even know.
Yes, I'm launching it right now. So if you can just choose, I'll give it 10 more seconds. Interesting.
Oh, not appearing? That's okay if it doesn't appear.
No, I'm still waiting. Okay, I have 11 responses. Okay, I'm gonna end the poll in 3, 2, 1. Okay, the poll, and I'm gonna show results. Can you guys see it?
And I can't see it on my iPad, Sasha. What are we seeing?
Okay, so we see that cash accounting has 2 responses, accrual 6, blend 2, and I don't know 2.
Okay, fantastic. So we have a nice blend here. And so for those of you that are using accrual already, I'll just reinforce why you do that and maybe help you understand why the statement of cash flows is so important as you get to this presentation. And for those of you that are in cash, get ready. I'm going to attack it. So the idea, one of the core principles of US GAAP accounting is the idea of the matching principle. We really want to match the expenses that I incurred to generate revenue. So I want to match. So if I'm in January of this year and I'm doing a lot of promotions, I want to make sure that I capture that promotion expense in January for that large amount of revenue I generated from those promotions. The challenge you run into is that the deductions from those promotions from like Unify and KHE don't come back for a month or 2, or sometimes even 2 years, and they come back in the audit and hit you. So if you're on the cash accounting basis, you're not going to recognize the those expenses of promotion until you actually get the deductions, and it won't match up to when those sales occurred. It'll be in a different month. So in that next check mark, so accrual versus cash, just being really clear, cash basis accounting is a method of accounting in which revenue is recorded when cash is received, and expenses are recorded when cash is paid out, and it doesn't seek to match them in any way. It's truly all when the cash comes in or the cash goes out. Accrual basis accounting is a method of accounting in which revenue is recorded when it is earned and expenses are recorded when they are incurred. Incurred doesn't mean the cash goes out, but it means there's a liability created that at some point I will need to pay that out. And again, the idea of matching the expenses with the sales is so core with accrual, and it's so important. If I don't have that, I really don't have an accurate report card coming every month. I might think I'm making money, but I'm really not. And I've seen, gosh, there's a really bad example of this, of a company where January 2 years ago, they did major promotions. They saw profitability. They then went and tried to raise capital based on this profitability and these high sales. And then months later, these deductions came in, and then the investor pulled out. Became a major problem. So let's dig in a little bit more. I give you a specific example on why accrual matters for CPG companies like yours. So with cash method, the January promotion I mentioned is not captured in January. So if you see on the left-hand side, you'll see I had sales revenue of $250,000, and promotions and returns was just negative $15,000 expense on promotions. Remember, I promoted a lot. And so what happens on this, and let me just go here, you can see that on the cash basis, I only recognized any cash that went out, which probably related more to December promotions, right? That took a month for KPIs Unify to bill back. Under the accrual, I matched the $75 in promotions that I spent in January to that $250,000 in sales that I had in January. So a much clearer picture of how I performed during the month of January. So I go across. What also happens is we'll see that cash, under the cash method, I'm overstating the promotions and returns in February and March compared to what I truly incurred relative to promotions in February and March, which are much lower on the right-hand side. And then here's where that example I gave you really comes in and hurts you. So in January, we had great sales, best sales we ever had in our company. And then our promotions were not fully recognized because I only recognized the actual cash, and those MCBs will be deducted later. I show a net income of $10,000. We're under accrual method, which is the more accurate report card. I show negative $50,000. This is a really big difference. That's $60,000, and it's extremely material overstatement of income. So let's go to the next slide here. Let's dig in. Let's talk about individual financial statements. And we'll talk more about this whole accrual accounting thing toward the end as we talk more about the cash flow statement. So on the income statement is like a video of your financial situation. It shows you how much money you made or lost over a period of time. And that could be over a month, a quarter, a year, multiple years. The balance sheet is like the photograph. So income statement is like a video. Balance sheet is like a photograph of our financial situation. What do we own? What do we owe? What am I worth? The statement of cash flow, I don't even put an explanation underneath it because it literally is telling you how cash is flowing in and out of the company. I'll go a little bit deeper into each of these financial statements as we go forward. On the income statement, I really try to figure out a way, and in fact, actually really try to figure out a way to connect the income statement and the balance sheet and show you how they're related. I think a lot of people believe that they're totally separate and how they go together. I think this analogy, which is the first time I've ever used it, but it made so much sense to me. And I hope it helps you too. So if you think about a faucet with water pouring into this bucket, the flow of water into the bucket is the revenue or sales that are coming into our company. They're going into the bucket. And what happens is those little holes is the flow of expenses out. So I'm filling the bucket with sales dollars that are coming in, and what's kind of trickling out or maybe flowing out fast, depending on your situation, would be expenses out of that bucket. And the next thing here is the water remaining in the bucket is the retained earnings from the balance sheet. So as that bucket ideally fills up over time, over many years or many months of revenue, that's the retained earnings in the company. And then the last step here is the net of the water added and subtracted from the bucket over a given period of time is our net profit. So in any given year, how much the water rises or the water drops in the bucket is the net profit. So I'm hoping that this analogy helps maybe in a very visual and in a somewhat concrete way, help you understand what's going on. So yeah, so we have revenue coming in, expenses going out, we have a net profit, all from the income statement. And then I'll go through here. And then the balance sheet is really the retained earnings. So any of that revenue that's staying in, net of any expenses over time becomes our retained earnings. Okay, so let's keep on digging. So reading an income statement. So revenue, so I'm in a little bit more detail here. So revenue, or we also call it sales or gross sales, is the amount of money that a company has earned during a specific period of time. It's the flow of water from the faucet maybe being our customers, and the flow of water is the sales dollars. The expenses again, it's the trickling of water out of our bucket, right? These are the costs that a company has incurred during a specific period of time. And we often think of expenses as being like marketing or sales or operation. But in many ways, we can think of like cost of goods as an expense. We also can think of promotions, which often is a kind of a contra sales account, is also truly an expense. It's taking things that are taking away from those revenue dollars. And then if we go here, the net income, again, is the amount of money that a company's made after all expenses have been paid. And that little kind of blue rectangle represents kind of this increase in income or dollars that are added into the bucket. So let's keep on going. And then this next area is ratio analysis. So thinking about gross profit margin and operating profit margin are two really core ratios that we use in the business. So gross profit margin is the percentage of revenue that a company keeps after paying for cost of goods sold. So it's like, hey, at a very, very basic level, taking out all operating costs, how much margin are we making? And I'd say a general guideline is that I use, and the number used to be 38%, is like ideally I want to be about 45% minimum to have a hope of being profitable in the CPG space. So if your margin today is 25%, hey, the goal really is to move to 45 and figure out how you do that would be a great goal. And then operating profit margin is really after I pay for all the expenses of operating the company, including promotions, cost of goods, and all my expenses, how much of that relative to sales am I able to keep? And just to make that visually more clear to you, and maybe one more step too, is the end in mind for these ratios is to be as high as possible while maximizing sales revenue. The problem of looking at, like, I've seen this before, people focus on gross margin, but then they do that by raising their prices, but then they hit an SRP that's too high, and then their sales drop. So it's very possible to maximize gross profit margin and operating profit margin in the short run, but end up like killing your company in the mid to long term because you raise your prices too high. So what I say, really, you can't look at any of these kind of ratios in a vacuum. We need to think about them holistically. So both the ratios to be as high as possible, so as much gross profit margin, as much operating profit margin as I can, while maximizing revenue is kind of like the counter to that. Great, so let's move on here. So for gross profit margin, you often see it, you'll see this line often in your financial statements right below the gross profit line. And in this case, you see gross profit is rising, which is nice. We're trying to move toward that 45% level. And the way we calculate gross margin percentage is taking the gross profit dollars, $37,500, which is, again, gross profit is calculated by taking my net sales of 175 in January, subtracting my cost of goods sold of 137.5, again for January, leaves me with $37,500, and that's that 15% gross margin calculation at the bottom. The deal is, if I can improve my cost of goods by lowering cost of goods relative to sales over time, I can increase gross profit margin. It's a very noble purpose. So if I take gross profit, 37,500 divided by 250,000, that's where I get the 15%. And operating profit margin, I have net income in this case of negative $50,000 in January. And I'm going to divide that by the sales revenue or gross sales of $250,000 to get negative 20% operating profit margin. And ideally, you want that to be positive. Reading a balance sheet. So it'll be very high level here. Then on assets, these are the things that you own, such as cash, inventory, property, and equipment. Liabilities are things that you owe, such as accounts payable, notes payable, and long-term debt. And equity is the amount of money that the owners of the company have invested in the business, plus any retained earnings. And the reason it's called a balance sheet is it has to balance. I've seen so many financials that are prepared like in Excel, for example, where they don't balance. It's not called an unbalanced sheet. It's a balance sheet, and it must always balance. And accountants often are very detail oriented and figure this stuff out for you. On assets, so to calculate equity, owner's equity, we take assets minus liabilities, and that should equal equity. So that's the whole balance that needs to happen. And I think what's really fun to think about is that equity, really a lot of equity is often the retained earnings, and retained earnings is that money left over in my bucket. So just kind of fun to think about that connection back to those earlier slides. So let's see here. And reading the cash flow statement. So I'm curious if anyone on this Zoom is using a cash flow statement today? And if you are, maybe you could signal that with a thumbs up or in some way in the chat for Sasha, because I think most companies I work with, 90% really don't use the statement of cash flows. So if you could signal that, and I'll pause for a second, that would be great. Sasha, are you seeing many people using the cash flow statement?
I don't see anyone in the chat box. There we go. Just P&L and balance sheet for me from Brian Bowers.
Okay, fantastic. So yeah, I want to go make sure I'm really clear about the importance of the cash flow statement. So if I'm doing accrual accounting, which is what I really want to be doing, I want to have an accurate report card, an actual reporting of what I'm doing and how I'm operating my company. I've moved away from the cash-based income statement. And when I did that, what happened is I kind of lost connection with what's happening with cash beyond just seeing it like go up or down on the balance sheet. The cash flow statement is fantastic at helping you understand like am I growing my cash? Am I losing cash? And where is that happening? So there's three key areas on what's called an indirect cash flow statement. And so I'm looking at operating activities, investing activities, and financing. A lot of people get confused on what investing means and often think it's related to like investors investing in your company, and that's not what it is. And I'll explain this to you right now. So let's dig in. So on operating activities, that is the amount of cash the company generates or uses from its core business operations. It's a good measure of a customer's profitability and its ability to generate cash. So it's really kind of income statement based. Investing, this is our company investing in our company. So the amount of cash a company spends or receives from investments in property, plant, equipment, as well as other long-term assets. And I'll just give you a quick side note. If you're trying to be in the venture capital world, investors generally want to see you, if you're like burning cash, they generally want to see you burning cash on the operating activities, usually like marketing, driving, things that are driving sales like promotions. At least traditionally, they haven't wanted you to be taking their money and use it to buy property, plant, and equipment, especially when co-manufacturers can do that more efficiently. So just a little tidbit for you. And then net cash flow from financing activities. So this is where investor money is coming in, or money that you're putting in. It's also if you're paying out dividends to the investors, you'll find that in this account as well. It's a really a good measure of the company's financing needs. So to kind of help you understand like even further where this all relates to the other financial statements. So the operating section of the statement of cash flows is really income statement related for the most part. The investing side is the assets and liabilities section on the balance sheet. And the financing side is really the owner's equity side on the balance sheet. And again, if we don't have a statement of cash flows and we're doing accrual accounting, we really don't have a good handle on what's happening with cash. And if we go back to that initial discussion that I had on promotions, that promotion we were doing in January, right, where under the accrual accounting, we were accurately saying that we're spending, hey, a lot of money on promotions in January. We're under cash, we didn't show it. And so how do we see for the fact that we really didn't spend that cash? And if you look at right here where that arrow is, on the statement of cash flows, there's a line for adjustment for promotions and returns. And we added back $60,000 essentially to the income statement net profit to show us that we didn't spend that cash yet. And that just helps you understand like, oh, okay, I didn't spend $60,000 in cash that month on promotions. And that's kind of good to know. At least in January, that cash didn't leave. It's probably going to leave in February or March, but it gives me a better understanding of what happens. It's really the bridge between, the cash flow statement is a bridge between cash and accrual accounting. And if you are doing accrual accounting and you're not using a statement of cash flows, you are flying blind relative to cash, and that's not a good thing. And this is,
I just want to say comment that Salsi and Laurel, they added a comment to chat that they both use the cash flow statement every week and have cash flow meeting every week.
That fits right into the next part of the discussion today, which is right here. Cash is king. So cash is our lifeblood. We are in, and I'll just give you a couple of data points to make sure you understand where we're at as a CPG industry. We're effectively in a depression in terms of our ability to access capital from venture capital, where that had been the primary source for a very long time. We have seen the biggest drop from like the highest evaluations to like now these like lowest evaluations that are happening for companies ever. There is still seed funding available, but you have to be really good. You have to have really, really strong velocity stories, ACV stories, ideally in a region or two, to help people truly believe that you can succeed if they have your cash. So that's a really, really important thing to understand in this moment. And so the other part too is, as for some of the larger companies on this call, Series A's are still okay. Series B valuations are down by 50% in the venture capital space, and there really is no Series C market at all. So if you just raise Series B capital, be thinking about how you become sustainable or find out some other path, because there may not be a Series C available to you right now. So we talk at VDriven, and Andy talks to our clients who we do accounting for about the importance, the absolute critical importance right now of having your eye on sustainability. If you remember that gross margin percentage slide that we had, we talked about being 45% or above. Hey, if I'm at 25%, I'm going to be rushing, trying to get to 45% without sacrificing sales. And that's the challenge. So remember on this slide here, net profit is not cash. I hear so many CEOs that I talk to, like, oh, my profitability, like what's happening to my cash? Like net profit really, I would say just disassociate the idea of profit and cash. You can be very profitable and extremely cash flow negative, especially if you're on the accrual basis of accounting. So again, that's why the cash flow statement is so important. Running out of cash today is the end. Sasha and I have been personally involved with trying to save multiple companies that were at the end. They're out of cash, and really at this point, there's almost nothing available. We have one company that we worked with that was worth over $500 million just 9-10 months ago. They had one misstep, and we were involved in an investment group that purchased the company for $25 million. Imagine being the CEO of a company that lost $475 million of valuation. So cash is everything. The focus of the CEO must be on cash first. It's the only thing that, I felt that wrong, but anything that's really real in the world right now is cash. Everything else I can recover from. I can't recover from running out of cash today. So that was our presentation. Let me get out of here, get back on video, and then I want to create space for any questions you have. We can go anywhere you want. Oh, let's see here. I guess you can go back here. I'm going to make sure I get this on the screen too. I'm creating space in my calendar. I'm usually like back to back, but we put together a couple afternoons where I have some space available. If you'd like to spend a little bit of time with me, it's no charge. I just really want to help where I can. We'll look at your financials relative to like cash burn, expenses that seem in or out of line, some ratio analysis as well, and at least give you some idea on a very specific basis relative to your financials. And I'm excited to do this. I hope you take me up on this, and I look forward to talking to you more directly about your financial statements and financial condition. And thank you on that. And let me get out of this deck. And
Thank you,
Sasha,
Luke.
I can't get out of that. There we go.
Stop sharing the screen. You still say sharing screen. Okay,
Yep.
perfect. And if you could also turn on your video, that would be great, so we can see you. Nice.
Okay, am I back?
Yes.
Okay.
All right, so we have a bunch of people here. So anybody has any comments, any questions? We have almost 30 minutes, so we can just dig into some specific topics.
I had a quick question around like trade spend and how you guys think about trade spend in year one versus future years for grocery in particular.
Yeah, this is a fantastic question, and love to dig into it. So trade spend, so typical trade spend we were seeing before the collapse of venture capital would be 16 to 22% of sales. It would be standard over time. What we were seeing, though, at the beginning for a launch of a new brand, for example, launching in Sprouts, your first big customer, we could see 35, 40%. And that includes the cost of doing business with K and Unify plus the promotional cost. So yeah, so typically I would say, just give you an example, Dan, and thank you for the question. We're often seeing, we're launching at a Sprout, so we're going to have a free case per store per SKU going in, which is going to be a huge spend for you, right? And then
I think it's actually 2 required now.
Some cases, I mean, those are negotiable too. So it depends on the category and depends on the relationship that you have or your broker has. We can have those discussions. Typically, we've been doing 1 at Sprouts. I don't think we have had to do 2 yet. So it's something that can be discussed. And that's the other part too. We can, we understand what the standards are, but we also can try to work around those standards if we're effective at what we do. So you have a free fill. Typically, you're going to do a strong promotion month 2, not month 1, because month 1 you're still dealing with the supply chain issues getting on shelf. Month 2 we go big. Month 4 we go big. Month 6 we go big. So that first year you could be in the 30, 35, and 40%, but over time that should kind of go back down into that 16 to 22% range. And where you are in that range depends on how competitive your category is. If I'm in functional beverage right now, I'm at maybe 22 or even more because it's so competitive. But if I'm in something less competitive, I could be 16% or even a little bit less. If you have any follow-up on that, Dan, I'm happy to hear it.
No, I just, I think, trying to explain that to investors that don't understand CPG of like, gross margin year 1, I basically say it's going to have to for snacks, I'm going to be at 25 to 30%, and then hopefully I'll be at 18 to 20.
Yeah.
For that.
Yeah, great question and great point, Dan. And if you want to message me, I'm on an iPad now, so I can't take notes, but I will send you over a deck from Propeller, which provides aggregate data. And anybody else that wants it, feel free to ask. It's aggregate data. It's a few years old, but it shows you by stage of company what their spends are in various areas, including like marketing, sales, and also promotional spend. And for one more step on clarification is that was before venture capital went away. We're still figuring out what that means for today. My gut is that we're going to see those numbers drop as companies have to be more sustainable simply because there's no funding out there. Okay, and I see a lot of people saying it'd be great to see this data. So Sasha, we can send that out to everybody after the call too.
Yep.
Good. Good, Lynn.
And in the early stages, for instance, we've been chatting about launching into a chain just to Sprouts. And let's say you're going to go nationwide or a portion of that, let's say 100 stores, 200 stores, whatever that may be, according to the national. What do you see early stage brands such as us allocate for spending for like geolocated promotions on Facebook or whatever kind of social media channel you want to use to kind of support that national launch? Because you can't do all the stores, that's just cost prohibitive. So I'm trying to figure out like a ratio, is it based on metro areas? What's kind of a back of the envelope formula as you build a financial model for that?
That's a really good question. So that Propeller data will be helpful for you also, because I think it'll share, I think it's like 20-something% of sales is spent in marketing for the average venture capital backed company. And again, these companies you'll see in this deck are all losing money. So if you have to be sustainable, it's not going to be that much. And I'll just talk to you a little bit about, and I won't go too deep because we're talking about finance here too, but I want to make sure that I share with you some of my philosophy and our philosophy at VDriven relative to like how we like launch at a Sprouts, for example. Like what is that approach? And are we hiring a social nature? Are we hiring an Ibotta? Like what do we do? And so what I'm finding like at a Sprouts is I want to use everything that's effective within that retailer's levers that they offer. So at a Sprouts, okay, I want to be doing the TPRs. That's no brainer. I want to be on TPR. I want to be doing in-store demonstrations. And I typically recommend at a Sprouts, I'm launching into 400 stores almost, and then I'm gonna maybe just do demos of the top 50 stores. And we can give you a list of the A stores at Sprouts. And so you can just focus on those, see if there's a post-demo lift, right? And so you're testing things before you go big. So in the old days, you raised $10 million and you just do demos at all the stores. But now we test it and then verify it. And you can even do 25 stores and test it and go. And then you can, beyond that, they have digital coupons. Digital coupons are so expensive compared to a TPR. Oftentimes with TPRs, I can help Sprouts often asks me to be margin percent whole versus margin dollar whole. That's changing a little bit. But margin percent whole means that to give $1 off, I don't need to give the full dollar, right? I might have to give just 60 cents. Being margin dollar whole means if I want to give $1 off, I have to give the full dollar. On a coupon, so digital coupon, I have to 100% fund the $1 off. There's no participation from the retailer, right? And then in order for digital coupons to be effective, I mean, Sasha has run these for many companies. They're not effective unless I'm giving 35% or more off. And so they become very expensive. The good thing about those is I can limit the budget. I think I can just, if I'm correct, Sasha, I can just say I'm gonna spend $5,000 on that. That's it. I can drive some velocity. They have a monthly flyer program that I want to be looking at. And then I have these things that are outside of Sprouts. And so if it's like Ibotta, Social Nature, right? And they're very expensive. I've been very involved with companies that have used Ibotta and Social Nature. No one has ever said that it paid back what they put into it, right? So no one. And I work with dozens and dozens of brands. Now, if it's something I'm just pulling and I have lots of cash, and it's another thing I'm adding in to just make sure I win, then so be it. I spend it. You will get some results, but you're not going to get an ROI if that's what you're looking for out of it. In terms of social media, digital media, those are really hard to create value for when you have a limited budget. And so like I would very much focus on things that are much closer to the sale, closer to the shelf, like demos, TPRs, digital coupons. Sprouts also has an influencer program of their own, which is super inexpensive to work with. Right. And again, I'm just talking about Sprouts specifically, but every retailer is different. They all have their own tools. But I would say if I was on a limited budget, I wouldn't be using like the Ibotta's and the Social Natures of the world. It just doesn't give the ROI that I would want. I'd rather do more demos in my mind. And Lynn, am I answering your question?
Yeah, and that's exactly kind of the point that I'm at as we're looking to expand on a channel. Where do we allocate funds? And you really addressed it because there's so many different options we could do. For us, we know sampling is king for us. We know that moves the needle, but you can't. 150 would be a lot of stores for us.
Yeah, yeah. Start with 25, and if there's an ROI on it, do more. Like do unlimited demos if you can at least prove they work. Right, but if you can't, and this is my thing now, is I validate everything, and even validate TPRs. You know, try out 50 cents, try out 75 cents, try out $1, and see where the most promo efficiency comes out. You know, try a BOGO, but you know, oftentimes you find the BOGO isn't as effective as a 50-cent off, and so continue to look at your data and what's going on and learning from it is so important. And also remembering timeframes too, right? There's this like tension of I got to perform. So typically at a Sprouts, you generally will have 6 months, right? Unless you're really, really bad. You generally have 6 months. So think about using that window effectively and also relative to your cash, right?
Got it. Thank you.
Yeah, you're very welcome.
Luke, this is Lauren Solash with Habiza Hummus. I wanted to just come back to actually the income line on the cash versus accrual. I don't know if it makes sense to pull it up, but I can sort of talk through what it was. Right, it's that very first line item. I think it was $250,000.
Sasha, could you share that, Sasha? Because when I share, I lose my screen. I'm on an iPad right now. Yes. So the starting of the indirect. I think it was the indirect cash flow statement that we had toward the end of the presentation, correct?
No, it was actually towards the beginning. It was one of the first slides that you flashed. Yeah.
Oh, so the income
slide 10, 11.
Okay, the income statement.
There.
Very good.
Yeah.
Yes.
Yeah. So on a cash versus accrual basis.
Yes.
Can we just talk about, sorry, I said income. What I meant is the sales revenue line.
Okay.
So can we just, if we just take January for a second, right? We have a lot of promotions in that month. Is the 250, is the 250,000, is that, and is it, first of all, is it the same in the cash and in the accrual? Is the 250 in the cash that came in from the, because how it works for us right now, this is the revenue is a big sort of sticking point for me, because we're fulfilling all of these orders, but as a new vendor, we're on a minimum of 30-day hold, if not a 90-day hold.
A 90-day hold, yes.
Right.
Yes.
So I'm trying to figure out, I've got my cash in my cash flow, right? It's when money actually comes in, but then in my overall, when I'm doing accrual, I don't put that revenue. I put that revenue in the month that I fulfilled the order.
Yep.
Yeah. Right. Fulfilled the order, produced it, fulfilled the order, and then you know, I'll see it again at a minimum 30 days, if not 90 days later.
Yeah. Right. Totally.
Okay. But from the, I guess, again, going back to this, so cash.
This
the
is
January-
oversimplified because you're exactly
Got it.
right. Because the cash and accrual cash, the sales revenue will be different.
Yeah,
Because generally with cash, I'm recognizing it only when I'm receiving the cash in.
got it.
Where accrual is when I invoice it, and that's a great clarification. And thank you for asking.
Okay.
Yeah, and is there a particular struggle that you're having? I mean, beyond like the fact you're not getting paid.
I mean, I
but
just don't get paid fast
it,
enough. But,
yeah.
yeah, no, it's no, and it's just, keeping, I keep the expenses in the month that I accrue them, right?
Yeah.
Which
Yep.
is actually, I keep my expenses, I where I am, I accrue them and I pay them in the same month right now. And I put the revenue when it is earned, but then on my cash flow, it's a full cash. So
Got it. Very good.
Out, revenue in. So
Got it.
Less a pain point for myself personally, but just making sure that I understand the difference.
Yeah, no, you do. That was a great question.
Okay.
And one thing I think one that comes up for me that I want to share is, like, we have a model that we use for clients internally. So it's one thing to have my income statement, balance sheet, and cash flow statement looking at the past. The other is like the future, and it's like, what does this mean? And I mentioned how important cash is. So we have a forecast model that takes into account what's happening in the income statement, what we're projecting is going to happen, but it'll flow through the balance sheet and create a statement of cash flows. And then ideally, you're seeing like, okay, where's cash every month, and where am I running out of cash?
Mm-hmm.
And so if I'm running out of cash too soon, it's like, okay, well, how do I adjust what I'm doing? Because it's not enough, right? Just to know where I am today. I kind of need to know where I'm headed. And so that's something that I highly recommend. If you do not have, it's not just an income statement forecast. It's really fundamentally what you need is a cash flow forecast.
Yes. Yeah. That's how I've set myself up. So where we are now, and then I've got rest of the year and maybe a little bit next year, if we get
fantastic.
That, right?
Perfect.
Thanks, Luke.
No problem. Thank you, Sasha, for sharing your screen. Great. I'm curious, Brian Bowers, what is your biggest pain point?
My biggest point is cash and cash flow, and it's a question I wanted to ask. I have no idea where some of the other participants are at, but just in general, if you had to guess in the CPG world for grocery shelf stable foods, I'm trying to narrow it down.
Yes.
If you had to guess, just because of the volume it takes to flip into profitability, because I'm in fundraising mode right now, and so if you had to guess, how long do you think a company needs to be able to operate to get to scale to flip into profitability? Because I lost money all last year, and I ran out of my own funding, had to seek some angel investment, and now that's dwindling. And so I have people who are interested in investing, but I'm struggling between asking for too much and too little. Like, I want to do it bare bones on a budget, but then it takes too long to secure some of the bigger accounts. I'm worried I'll run out of cash again. So what do you think is a safe runway for a company? Is it a year? Is it more than that?
Yeah, this is a great question. I think right now, if you're not profitable today, if I can put together a credible plan for how to get to profitability over the next 6 months to a year, that would be ideal. Now, I'll give you an example, and it won't be specific, but I work with a brand that's been a client of ours for a number of years. And we still are only at 28% gross margin, and we're losing money. But we were able, because we were something very differentiated in the market, we were able to raise capital. But what we have this year is this forecast that shows that margin going from the 20s up to the 40s, and we're marching. It's like we are marching as fast as we can. We have a credible plan. We did a Series A last year. We just did a kind of a bridge, kind of B round right now. And we were able to raise capital based off of us being able to show that we will be sustainable by the end of this year. It's a credible plan. It's a crazy plan. It's hard, but we're making that happen in this company. And so I just, taking it at a bigger level, it isn't size of company's profitability, right? It's really like almost nobody was making money. And you'll see that in the propeller data we'll share. I don't care how big you were, no one was making money a year ago. Now we all need to figure out how to make money. So, if you're not margin positive, we got to get there. And again, that's going to usually be like some price increases and improving my margin and being very operationally efficient. And that's something, Brian, if you want to sign up for some time with me, I'd be happy to kind of help you dig in and help you identify the areas where you can focus on.
Okay, great, thank you.
Yeah, you're welcome. And I just saw a note come by that the bigger companies drain your money fast, and it's the bigger retailers, and that is true. And so it's if I'm wanting to get into like a Sprouts, it's like I need to understand that I'm not going to be profitable those first 6 months. No one really is, right? I have to go deficit spend to earn my space. Everybody wants, it's the holy grail, it's the panacea. Everyone wants to be there. And so it's like we have being really intelligent about it. And how we grow brands at V-Driven is generally, if you're really young, we're gonna really focus on a region and really just own these independents that are gonna be much easier and less expensive to work with, and then build that story, get our packaging right, get our promotional strategy right. I don't want to be figuring that stuff out at Sprouts, right? I want to already know what works when I show up at the door, and have great thought leadership that's going to make sure I don't go bankrupt because I launched in Sprouts Farmers Market. And we had a company yesterday that launched in Sprouts, and they actually had a meeting with Sprouts, and they are at the edge of bankruptcy because they launched in Sprouts and they just didn't perform and at the level they needed to. It was really, really hard. And it's like, do you want to go for broke, or do you want to maybe take more of a long range view of it? So thank you, Brian, for the question.
I think, Lynn, do you have a question?
Yeah, I got a second one if you don't mind. If the space is open, I'll take it.
Take it.
We are in the process of building the financial model for fundraising, I think, as you know, and going from cash, which Peter loves accounting, to accrual, which I'm much more familiar with. It's painful for him as a true business owner. He loves looking at the bank balance count. But in building the model, and specifically in the projections, what do you typically see as the granularity on kind of the SKUs that you're looking for? And an example would be, obviously, we've got multiple SKUs packaged for us, but we've got different flavors beyond that. And then we have different levels. So when you're developing those projections, are you kind of grouping them, or do you like to see them, or do investors typically like to see every single SKU that you have, whether it's on direct to consumer or for wholesale? What do you typically best?
Yeah, it's a great question, Lynn, and it really depends in my personal experience of doing this, working with a lot of different types of investors. An angel investor that has no experience in the space is going to be less caring about granularity. They don't understand it anyway, right? But if I'm taking on a sophisticated venture capital investor, and I've been through this multiple times, they're going to dig into every detail you could ever imagine. You better be able to tie everything you say back to some truth that is like, otherwise your credibility is gone. What do they call it? They give you the offer letter, but it's a term sheet. That term sheet will be out the window. And so it's really important that everything you say to a high level investor is based in some level of like sound reasoning, or you're gonna be in trouble. Talking to angels, I'm not going to be as granular. They're just going to glaze over. They're not going to understand. So there's a continuum, right, between an angel, a less sophisticated angel, and a very sophisticated high level venture capitalist. So it really depends who I'm working with. So Lynn, if you're thinking it's angels, I wouldn't be as, for myself, I would have the data. I'd want to know that what I'm saying is true. But if I'm talking to angels, I wouldn't go into it with venture capitalists at a high level. I want to be able to get really, really deep, because they're going to get deep. Does that answer your question?
Yes, thanks.
Yeah, and you can help Peter feel more comfortable by just showing the statement of cash flows. I mean, if he's a real cash guy, he can just live in that financial statement. He'll be very happy.
Yeah, no doubt. Good point.
Okay.
And then
Very
we have
good.
Tal. She I think had a question as well. Hi, Tal. I might be not. Tal, are you here?
Okay, Tal, we miss you.
All right. Are there anyone else?
I'm curious if Dom has a question. Dom is always very inquisitive.
I think you're thinking of some other Dom, right?
No, the Dom.
I'm just listening. I'm not an accountant, and I don't do that, as you know. So I'm just trying to increase my own knowledge about what I should be looking for and how I can help our business.
Okay. Good, no problem. And one thing I want to share, and Dom, if you have any questions, let me know. But I just was on a call with a brand that I spoke to last time a year ago. They're not a client of ours right now, but they have grown a lot. They have this opportunity for 450 more store doors. They said I don't have the working capital, and so we had a quick talk about that. And just to put it out there, because I think we're all thinking about cash right now, or we need to be. There's this thing called a 7A SBA loan that you could look at. If you don't have a contact there, I can connect you with someone who can help you. There's also a Bolt loan, and the Bolt loan, as I understand it from SBA, is usually if you're like over $1 million in revenue, is an easy access to $150,000. That's the maximum loan, and you don't have to have that much in sales or even profitability to achieve it, and you don't need to even have any assets, from what I understand. So like, if you need help connecting on that one, let me know. And then for one of our clients who's actually on the call today, we actually dug into factoring, and this company, I was really impressed with the rates. I think overall we were seeing 12% annual rates on factoring, where if you're getting POs in, you can actually be paid the cash almost immediately. And then the other one would be on actual invoice. As you're invoicing, you can collect that money, usually 80% of it, and then they collect it as the money is coming in through what's called a lockbox. So a little bit complex to get into in this last few minutes, but I'm thinking factoring is something that we if we have any cash concerns, that we all are digging into, because it is an option out there.
Okay. Look, and I was able to find the popular data. I can share my screen if you want to quickly, unless anybody else has other questions.
Yeah, and this data, I believe, is like 3.5 years old. So again, it was during the time of the heyday of venture capital money. But you can see this is CPG spending by stage. You see that across the horizontal top in gray is like the amount of revenue and what they're spending on promotions. And I think, and frankly, Dan, I think you asked the question, I think the promotions are understated in here, if you really think about the cost of free fills. But you can see where that total returns and allowances line is, where you see like under 2 million is 22% of sales, and it's generally above 20. Yeah, so that's just to be aware that that's where that was a number of years ago. Under 12 million is 28% of sales being spent on promotions and allowances. And you can also see going down below, like sales at 15%, marketing at 24% for that under 2 million. You see marketing drops as you become larger. As you go from like under 6 million, you're at 13%. And then as you're at under 20 million, you're under like 10% of sales. So this is just guidelines for venture capital backed companies, just to get an idea of like, if you were to go spend as much as you could because you had unlimited capital, this is what you would be spending if you're doing a composite of like thousands of CPG companies or hundreds of CPG companies. So we'll send you this data, guys. Just remember, it's a few years old, and I do think we have to be much more moderate in today's environment than what you see here. Cool. Any more questions?
Okay, I think we can slowly close this. Look, what do you think?
Okay. Yeah, I'm just very honored that all of you took time to spend time with me today. I hope that I created value for you, and maybe if you already knew accounting, gave you some insights that you hadn't thought of before, and if you were really a novice to accounting, that you're starting to feel more comfortable with it. And Sasha, if you want to bring that QR code up, again, just want to truly invite you, if you would like to spend a little bit of time with me over the next week. I think it's over the next week or two that I created some space in my calendar. I'm happy to go look at your financials with you, identify areas where I have concerns, or maybe areas to celebrate, especially as it relates to profitability and cash flow, and even put together a little bit of a plan for for how you go forward. I'm happy to do that. Sasha, anything else?
Thank you, Luke. I added the link in a chat box as well. So it's awesome to see so many people on this call. I think this was like one of the most attended masterclass that we've done. And so it's great to see that you guys are interested in learning more, and that hopefully we provide a lot of value for you. We'll have another masterclass again in June. It's going to be more of like a panel about alternative ways of funding. So you will be receiving some more information and invitation in the next couple of weeks. So we hope to see you there as well. And yeah, let us know. Feel free to reach out if you have any questions, also ad hoc. We are here. So
awesome. And we'll send you out a survey too. I really appreciate your feedback. It's important to me that I'm creating value for you guys in these calls. Thank you.
Thank you.
Thank you so much. Bye,
Thank you.
guys.
Bye.
Bye.
And yes, we'll be sharing the recording chat. So you'll get it. Okay, bye.